So let's give it another minute, and then I'll kick off. I think numbers, I'll let more participants come in. We'll give it another minute, and then I'll kick off. Okay, Tej, should I kick off?
Yeah, sure.
Okay. So good afternoon, folks, and welcome to Marcellus's webinar on the Kings of Capital. The theme of today's webinar is why are bad debts not rising in the Indian banking system, right? So we are halfway through the results season, and it's evident from looking at the results of large lenders that the credit quality pain, which was widely anticipated to fructify 6 months ago, it was widely expected that the financial system would be hit badly by COVID. Why aren't we seeing that show up in the results that the big banks and NBFCs are declaring? So with us today to discuss the subject is my colleague and our Kings of Capital Fund Manager, Tej Shah. And we are also privileged to have today with us Mr. R Gandhi, former Deputy Governor of the RBI, and currently the RBI appointed Board Director on the Board of Yes Bank. And very grateful to Mr. Gandhi for taking time out from that board meeting and joining us today for this special session of Kings of Capital. So folks, we'll kick off with Tej giving us the data on what have we seen in terms of credit quality pain so far in this crisis. And then we will request Mr. Gandhi to share his thoughts. Given his extensive experience, we'll request Mr. Gandhi to share his thoughts on what's going on in the financial system. The reason for doing this call, just to sort of step back and reflect a little bit, is when we have reached out to many of you over the last 6 months for discussions on Kings of Capital, people sort of tend to take polar views. One point of view is it's extremely stressful out there. The economy is in bad shape. There'll be lots of credit quality pain, and one group of people are very alarmed about the situation. And another group of people are taking the view that, look, yes, things have been painful. The worst of the pain is behind us, and this is a great opportunity to invest in first-rate lenders. This is a great opportunity to invest in the premier lenders, the premier financial services franchises at reasonable valuations. Which of these two viewpoints is more believable? Is the gloom and doom and alarm viewpoint more believable, or is the viewpoint that the worst is behind us and you can buy first-rate lenders at very attractive valuations, the more believable viewpoint? We'll sort of oscillate, we'll weigh up these two viewpoints over the course of the next hour. As Tej presents and as Mr. Gandhi shares his thoughts, please feel free to put your questions in the Q&A box. From around 6:30 onwards, we'll start taking your questions. So request you, Tej, to just kick things off to give us your views on this current situation.
Sure, thank you, Saurabh. So what we saw even before COVID, just to start off with where we were before COVID-19 hit us, we had already seen about 6-7 years of pain for the banking sector as a whole. It started off with Raghuram Rajan's asset quality review in FY14, FY15, when NPAs at a sectoral level were around 3-4%, and then it shot up to about 9-11% over a period of the past 5-6 years. And then every year there was some sort of challenge for the sector as a whole. We saw demonetization, we saw GST, we saw the ILFS crisis over the past 3, 4, 5 years. And that is what led to the NPAs increasing from about 3-4% to 9-11%. So even before COVID hit us, we were seeing a lot of challenges for the sector as a whole. Just when it was getting apparent that the corporate stress might reduce, just when the stress on the balance sheets of these banks and NBFCs, it was looking like that stress might recede. We saw that COVID hit us at around the beginning of this year. And it was widely expected in March, April, May that there will be large issues around NPAs, there will be large issues around the balance sheets of banks and NBFCs, as a result of which the bank Nifty itself tanked around 40% in a period of about 2 months. So early estimates indicated that because of COVID, NPAs at a sectoral level will inch up by about 1.5 times, from about 8 times to 12-13 times, to 8% to 12-13% by the end of this financial year, by the end of FY21. So public sector banks, NPA levels were around 11%. Even in a baseline scenario, they were expected to increase to 15-16%. Similarly, private sector bank NPAs from 4% were expected to go up to 8-9%. As a result of this, what was expected was that the capital adequacy, which for the sector was at around 13-14%, it would go down to around 12-13%. What this would have translated into was that by as soon as the end of FY21, there would have been 5 or 6 banks in India who would have been below the 9% threshold on capital adequacy. So in just a period of 9 to 12 months, just because of COVID, we would have seen 5 to 6 banks in India who would have been below the 9% capital adequacy threshold. Another way to look at this is that before COVID, at a sectoral level, Tier 1 was at 10-11%. The capital adequacy at 14% translates into Tier 1 at 10-11%. That would have come down for about 6-7 banks to 5-6%. As a result of which, we would have seen a massive consolidation in the banking sector. Because of the increase in NPAs, Tier 1 getting wiped off, 6-7 banks seeing their Tier 1 go below 6-7%. However, what we have seen what we have seen as early indicators, what the results are suggesting, there have been 2-3 lenders, 4 lenders who have given out September numbers as well. We've seen what happened in March and June. What we are seeing early commentary from these lenders is that, say for example, Kotak Bank has said that collection efficiency is at 90-95% of pre-COVID levels. Similarly, HDFC Bank is saying that collection efficiency is at 97% of pre-COVID levels, and they expect it to reach to 99% over the next 2-3 months. Similarly, other banks have said something similar. The reason behind this, what we are seeing is there are 2-3 factors at play. One is the ECLGS scheme of the government. So this was a scheme which was eligible, which was eligible for all banks and NBFCs and for all MSMEs who had standard accounts as on 29th Feb 2020. Any exposure up to 25 CR, which was a standard account, could have availed this scheme. As a result of which, what we are seeing on this chart is, by June 20 itself, within about 20-25 days of the ECLGS scheme being launched by the government, disbursements to MSMEs were well above pre-COVID levels. When we split it by banks, we see that the public sector banks were the most active in terms of disbursements to MSME lenders, to MSME borrowers, and followed by private sector banks and NBFCs. So this was one of the major reasons that about 20% of your existing borrowing you could have availed as additional finance from your existing borrowers. And this was because this was guaranteed by the government. The banks as well as NBFCs saw it as a good opportunity to lend at 8-9-10% with a guarantee from the government itself. So it was risk-free 9%, which the banks and NBFCs could avail. Coming to our portfolio and what we have seen for lenders in the Kings of Capital portfolio. So we've seen that at the end of 3 clear data points, at the end of the first quarter, in around April 20, we saw that moratorium book as a percentage of the total loan book on average was around 25 to 26-27%. So about a fourth of the loan book was under moratorium for lenders in our portfolio. By the end of June, by the end of the first quarter of this financial year, when these lenders reported numbers, this number had fallen to less than half of what it was in the previous quarter. It had fallen to 11-12% by the end of June. And our lenders had a capital adequacy, a Tier 1 capital of 18%. So almost twice as much of what the sector as a whole had. The sector Tier 1 ratio is at 9-10%. While lenders in our portfolio on average have a Tier 1 of 18%. So leverage, which is half of what the sector is at, Tier 1 twice of what the sector is at. Secondly, moratorium at only 11-12%. The third data point, very important data point, is that the lenders in our portfolio on average already have provided for about 10% of the moratorium book. So 10% of the loan book is under moratorium. By the end of June itself, they had provided for 10% of this book under moratorium. So which is 10% of 10%, which is 1% of their overall loan book. So our lenders NPAs before COVID were 2%. They've already provided for an additional 1%. So they're already well covered in case NPAs rise by 50%. What we saw at a sectoral level, 8.5% going to 12.5% is a 50% rise. In case the same happens with our lenders as well, they've already provided for that because they've already provided for about 1% of their loan book. Now, because of the various dispensations, whether it's the Supreme Court order or whether it's a moratorium itself, we've seen that NPA numbers themselves have been masked because these lenders are not able to report NPAs currently. So as a result of which, the NPAs are actually reducing on a reported basis. However, the three lenders in our portfolio, which have reported their September numbers, they've continuously provided for these NPAs, irrespective of whether these NPAs are getting reported or not. So we're seeing that whether it be HDFC Bank, Bajaj Finance or Kotak, the provision coverage ratio is continuously inching upwards because number one, NPAs are not getting reported, and number two, these lenders are being conservative and they are providing for more than what is actually required for. And that leads us to the four questions that we'll primarily try and address with Mr. R Gandhi. First one being, why are bad debts in the system not rising, like we discussed? Second, what is the outlook for these private sector banks as we move into the second half of FY21? Thirdly, how easy or difficult will it be for these banks to take advantage of the restructuring norms? And the fourth question being, what is the outlook on the asset quality of the NBFC sector? So over to you, Saurabh.
Thanks, Tej. Thank you.
Thank you, Tej. Good evening, everybody. I'm very glad to be interacting with all of you in this evening. Thanks for the opportunity to Saurabh, who extended this, and I grabbed it immediately. First of all, I was a bit surprised about the way the topic has been designed. We are asking questions, why things are good, are happening good. Right? So in a lighter way, because in any way, as a professional, we need to be analyzing whether things are happening right, bad, good. We should always try to understand what are the various contributing factors which have contributed to this. So that way it is all right. A professional exercise is always welcome. So first of all, yes, around the time when the COVID impacted the economy in late March of this year, as Tej has already put it, economy had already been coming down, both in the economy as a whole also there was slowing down, and also in the financial sector also for several years we had been grappling with the problem of stress in various type of assets and capital problem, etc. COVID has further accelerated that situation. And the despondency which was around everybody's mind was during April and May, when the economy was completely shut down. And added to that, when the financial stability report of Reserve Bank came in June, it had given kind of a negative outlook. That's what Tej also presented, that it had kind of predicted in stress situations, even in normal situation, the NPA of banks could rise to 12.5% by year end, and in the worst case scenario it can go up to 14.7, and all those analysis it had made. And it had also given certain information relating to the extent of moratorium that had been availed at that time, that because of up to May, I think that was the figures that was available, that which said that 50% of the loan book of all the banks and 50% of the customers had kind of availed the moratorium. So by the natural projection or assumption people made was that this major part of this moratorium book will go into NPA. So on that basis, the expectation during June, July, on many people's mind was that the stress will continue or worsen, and the banks will have banks and financial institutions, NBFCs will have serious problem of asset quality. Whereas it has not actually happened, as Saurabh also mentioned that, and the figures that shown by Tej, that as month on month, when we saw the figures coming up, it is giving room to, through anecdotal evidence and other leading indicators, it gives an impression that we are actually not going to have such a serious problem about the bad debts. So how it happened and why it is like that. Let me put some figures. If around June, when there was such a all-round negative expectation about the asset quality, one figure that came up at that time started kind of raising little different questions in my mind. I was looking at the outstanding credit figures published by Reserve Bank of India. That throughout this period, right from March, end March of this year, month on month, or every time there is a bank publishes in their weekly statistical report and other thing, the credit has, outstanding non-food credit had been consistently coming down. It was, for example, it was at 103 lakh crores in March end, the last reporting Friday of March, that is March 20, and even in the latest figure which has been published, it is 102.60. And throughout this period, you will find the curve have been kind of coming down, except in the last 4-5 weeks, I think it started picking up. But even then, it is still lesser than March figure. That means what? People and businesses are repaying their loans. If our assumption that all of them had difficulty in terms of cash flow, in terms of income generation, in terms of profitability, in that case, how is it that this has happened? That was the first question I started raising. That is one. Then second, I was looking at the deposit figure. Deposit has been consistently growing throughout this period. Deposit across, whether it is current account deposits or term deposits or whatever it is, it was picking up like anything. And as we speak today, during this fiscal post-COVID, 7.5 lakh crores of additional deposit have been accrued to the banks. How is that it happened? If the economy is not doing well, yes, to some extent, there will always be a tendency for cash preference during the safety preference during a period of stress and economic crisis. That will explain, if at all, a portion of the deposit accretion. But this kind of large accretion, how do we explain? And this is actually, if you look at the last decade, almost every year, the total average accretion of deposits have been in the region of 6 to 7.5 lakh crores or 8 lakh crores only. That we have reached that in half year itself. So that kind of surplus, how is it that people and businesses could achieve during this period? That was a second question. Third question, that also, when you looked at the currency in circulation during this period, post-March figure, that during the COVID period, currency in circulation have increased by 2.5 lakh crores. That means that people have surrendered their cash balances or their account balances with their banks and drew this cash. So that means that much additional surplus they had. So together, if you add up all these things, businesses and people, 1 lakh crore of 1.5 lakh crores of repayment of debt to the banks, 7.5 lakh crores of additional deposit, even after withdrawing 2.5 lakh crores of cash. That would add up to something like 11 lakh crores or 12 lakh crores of total surplus in the hands of the people and businesses during this period. From where this money had come? If we had assumed, and rightly, that there are very, very visible sectors of the economy which have been totally devastated by the pandemic, like the airline industry or service industry or hospitality industry, entertainment and all, that is definitely true. But if you accept that, that would mean that there are certain other segments of the economy which have been really been thriving during this period, which generated extra income for themselves or cash flow to themselves, and that came as deposits to the banks. So that is one kind of inference we can take. Then another, from where this had come, if the people and businesses have got this much 12 lakh crores of something, from where it had come. That is where we have to look at the other segment of the economy. There are typically people and businesses, if we consider it as one block. The second block which we need to be looking at is the government. And the third block we should be looking at the foreign sector. And the fourth will be the Reserve Bank, the central bank. So if you look at this way, whether excess money has come from the government to the people and businesses, certainly yes. Because during this period, both the central government and the state government together, they had borrowed on net basis the equivalent of 10 lakh crores of rupees. That was in addition to the tax collection and other accretion to them. Sorry for little puja is going on. There may be a little bit far away.
Sir, we need the puja as much as everybody else. So I think the puja is completely welcome. It's auspicious, sir.
Okay. So the central government and state government together have borrowed 12 lakh crores of rupees during this period. Additional, like their net borrowing. That is the one which kind of passed on to the, because when they spend, it is income for the people and businesses. And that has come. That is one explanation. And the accretion to the banks, the deposit 7.5 lakh crores of rupees, that also you can clear, because as I said, that credit has been coming down. Where they were parking, all of them were putting in government securities as investment. That government investment by the banks into whether it is SDL or government securities, that equates to, during this period, the 7.5 lakh rupees. So excess credit, excess deposit accretion that had gone to the government as by funding of their borrowing, and entire funding by the governments, it had come back to businesses and people as income. So that kind of fulfills one circle. Second, what about the foreign? Because by the foreign segment can kind of give extra flows to the economy as a whole. Yes, during this period, there was a heavy flow in terms of FDI and FII and ECB together. If you all take up that a proxy for that, we can look at it is from the Reserve Bank's balance sheet. Reserve Bank's accretion to the foreign exchange reserves during this period, there was something like $84 billion. And Reserve Bank balance sheet has increased during this period to the extent of 4.5 lakh crores of rupees. This 4.5 lakh crores of rupees, the corresponding increase in asset, if you look at the Reserve Bank balance sheet, that is foreign currency accretion, foreign currency assets. So the net foreign surplus, foreign inflow surplus, after market has assimilated it for its own requirement like imports and other things, the net surplus that has been absorbed by the Reserve Bank, that completely that has taken over. That's a complete another circle of fund flow. So the assumption that I'm making, or the inference that I am taking out of this thing, is that there is a segment of the economy which is not so visible, which is not in the normal radar of media attention or experts' attention. They have been receiving very good inflows in terms of liquidity or cash flow or income or profit, whatever, we do not know right now. But definitely what is true is that that segment has been receiving good one. And that is the one we should be, that is the first assumption I am making, that there is one part of the economy, sizable part of that, not just one part, sizable part of the economy is doing well. Now to reaffirm that hypothesis, you look at various indicators that come up. So first thing is GST. GST, because that is a clear parameter of economic activity, the collections, that because that directly gives the minimum level of economic activity that has happened, because the much beyond that would have also happened because there is a part of the economy is not paying any GST. So subject to that, if you look at the GST collection, how it was growing. April it was 32,000 crores, May it was 62,000, and June it was 91,000, July it is 87, August it is 87, 86, and September it was 95. So if you look at this way, that corresponding figure that the previous year, that is, it was all around 1 lakh crore plus. So consistently, the collection gap has been narrowing down throughout this period. Month after month, the collection has been narrowing down. Sorry, gap has been slowing down, narrowing down, and that indicates increased economic activity. That's number one. That anyone will easily accept that. Now look at the quantum actually had happened. If against that 1 lakh crore or 1,10,000 crores of previous year in each one of these months, if we have reached 95,000, 80, 90,000, etc., that means that on the assumption that half the economy was not performing well, it is the other half which is performing well. If it had contributed to almost 85% of the collections of the previous year, that means that this half is really, really thriving. That's a conclusion we should reach. Otherwise, or even the assumption that other half is not performing is also not correct. Even by segments which are not, which visibly we think that has been worst affected, even there, in those segments also, some economic activity is going on, and they are also collecting GST, and that is why this GST collection have now reached something like 80%, 85%, 90%.
Just to be clear, sir, what you're saying is, if we know airlines, hotels, transport, restaurants are suffering, then to offset that suffering, there must be other bright spots in the economy, because how else can we explain that the GST collections have normalized?
That's right. Because the GST collection is a clear indicator, barometer of economic activity that everyone will accept. Because unless you have actually sold your goods and services, you are not going to pay GST. So then naturally the activity has happened. If 80 to 85% of previous year collection has been achieved now, that means that 80 to 85% of previous year economic activity must have happened. That's a simple assumption we should make. And if you assume that some sizable portion of the economy has not been performing today, that means that the other segment which is performing must have been performing much better.
Yes.
Unless otherwise, how is that we reach this 85? That's why. And second indicator, leading indicator from where we can reaffirm this position, relates to the toll collections. Toll collections are almost near normal, they say, in terms of goods movement, not people. Passenger traffic, that is obviously it is not happening sizably, that we can grant it. That the rest of the actual toll collection today in major part is coming from the toll collected on goods moved. That means goods are moving across the country. That means there is production, there is demand, there is purchase. So that is another indicator through which we can come to the conclusion that there is economy is actually reviving in a robust way. That is it. Then everyone clearly grants that agriculture has not been affected at all throughout this period, right from even during the lockdown period, it was going on. Activities was going on, and the monsoon has been good. So that is contributing and creating the necessary demand from the rural segment. That is another part which factor we have to mention. Yes, the government support towards the special packages under the COVID program to directly transfer large sums of money to the affected parties, whether it is farmers or there are people, migrant laborers and others who got. You may argue about the quantum, whether it is sufficient or not. That's a different question. But sizable portion of money has been transferred from the government to these people. And all these people would normally, because they do not have the capacity to save this money, they would have definitely spent it only. When they spend, it is actually consumption demand. Then that leads to purchase of goods and services. So that's why to that extent, additional economic activity has, or trading activity has happened. That's another thing. So like that, if you look at this way, you will find that you will tend to come to the conclusion rightly that there is something which is happening in the economy under the ground, under the radar, which is really good. And that is a reflection which is happening on the books of the banks. Because when an asset becomes non-performing, for two reasons it will be. One, the borrower is unable to repay. Second, the borrower is unwilling to repay. These are the two simple reasons, right? So we have always taken it that they do not have the capacity today because of the negative impact of the COVID. These people have lost their businesses, lost their cash flow, lost their income, and so they would not have been able to repay. That was kind of taken from the earlier position that moratorium, 50% of the book as availed moratorium. Availing moratorium, we equated with stress and incapacity to repay. That was assumption which is wrong. People looks like that people have taken it because it was available. Moratorium was available. That is number one. Initially, moratorium was supposed to be asked by the borrowers. Later on, the bank gave a ruling, no, moratorium should be automatically be given. Whether the party is going to ask or not, you give the moratorium. So there were parties who were ready to repay because, as I said, that they all had cash, enough cash. They could have, if it is a normal court, they would have paid. Instead, because there was no demand from the banks or anything, they chose not to repay initial period. Later on, it was explained by the bankers to them that by not paying, you are not going to gain much except this 2-3 months or 6 months period of non-payment. Afterwards, it will become due. And when the moratorium is lifted, you need to be repaying this only. So why don't you pay it now itself when you have capacity? When such a kind of posture had been advised by the bankers to their borrowers, but many of the borrowers who are normally willing payers, they are all normal people. So when they had the capacity, they found that it makes sense for me to pay back whatever is the dues rather than just avail the moratorium during this period and other thing. So that way you saw the figures given by Tej that the banks recovery collections have been increasing from 80 to 90 to 95. Now they are all almost near the normal 100%. That means that people are willing to repay also. So both the willingness is there and the capacity is also there because they have got enough surplus. I'm talking about that segment which has got surplus. I'm not talking about the other one which has been affected. So this the segment which have got enough surplus, they have been duly advised by the banks and their collection agents or representative, whatever it is. It is better to you pay off rather than trying to postpone your further postpone just because moratorium is available. So that way we find that the collections have been robust. So that is why we have to clearly understand the mindset of the borrowers. The worst case of borrowers, they are already NPA even before the COVID affected our economy.
Mr. Gandhi, what we'll do at this point is we'll request Tej to take some of the questions from the Q&A box. And whilst Tej sort of summarizes the questions and poses them to you, I'll quickly summarize what you've told us, sir. Because I have to confess, this is what you've told us is compressed wisdom, and I'm summarizing this as much for my own benefit as for the audiences. So the step one of what you said was that, look, you can see from the RBI data that every month credit outstanding is coming down, currency in circulation is going up, and both basis your reading of the RBI data and our discussions with several unlisted lenders, we can see that there is both willingness to pay and ability to pay. And therefore, the question then arises, how come the stress in the economy isn't of the magnitude that we'd expected it to be 6 months ago? You looked at it as an RBI, as someone with an extensive experience of looking at RBI data, you could figure out using the macro aggregates that the stress isn't as much. We didn't have that expertise, so we spoke to a whole host of senior bankers from the unlisted sector, and they validated exactly what you said. Your hypothesis is the reason the stress is lower than people like us had expected it to be 6 months ago, broadly twofold. One is clearly the government has spent money, and broad quantum of government spending you're saying is in the vicinity of around 10 lakh crores, 10 trillion rupees. And the second is, we can see from the RBI's forex reserve swelling that there's been around 60, 70, $80 billion of foreign money coming in. This is aggregate of FPI, FDI, and ECB, etc. Right? We add up the so if you had to sort of just add it up, whilst you were talking, I tried to do it through both ways. It looks like we've had a $150 billion stimulus, roughly $150 billion stimulus, of which 2/3 is the government spending more. Roughly 2/3 is government spending more. 1/3 is foreigners pumping money into India. $150 billion translates into around 5%. Yeah, 5% of Indian GDP. $150 billion translates around 5% of Indian GDP, and that has been the inflow which has buffered the economy, which has sheltered the economy as we went through the last 6 months, and that's why you're positing the hypothesis that since we clearly know that sectors like transport, like restaurants, like airlines, like shopping malls, cinema halls, they're clearly suffering. That therefore must mean there are other sectors which have done better than expected, and potentially these are sectors where government money has gone in, and perhaps foreign money has also benefited these sectors. Right? That's where we are. Tej, over to you. What are our clients asking in the Q&A box?
Yeah, one of the questions that we've got is, what is the outlook on retail credit and unsecured credit? Is it going to be affected more than other segments of the banks and the NBFCs?
Yeah, retail credit, one thing is that during the moratorium period itself, based on Reserve Bank's guidance, banks have extended the EMI period. That's the way most of that, that has been, again, as I said, automatic. First, that's by default, the banks have extended that period. If only the customer does not want, it would have been recorrected. Otherwise, it stands exempted. So that way, first, the existing loan book, extension of the EMI period, it has a kind of given a little breathing space for those borrowers. But as I mentioned, that they might not have needed it compulsorily, but because it was available, everybody has taken it. Otherwise, it is because, as I said, that the capacity to repay is there based on the figures, as we said, that deposit accretion which has happened across this period, that clearly indicates that people have capacity to repay. That is the number about the existing book. Then whether going forward, is it going to becoming bad? That is unlikely. Number two, second question, part of your question is that what's the further prospects of increasing the retail book in the coming months, right? So that is the second part of it. That is where, yes, because retail had been clocking up for the past 7-8 years consistently. It has been growing because all the banks have slowly started shifting their focus on the retail book, having burned their fingers in the corporate and infrastructure and big ticket one. Everybody has now shifted towards retail segment. That's the number one. Number two, based on the e-commerce and fintech and others, the propagation of retail loan, it has become very, very easy, both in terms of onboarding, number one, in terms of underwriting, because better models, better credit information is available. So that way that has been made more robust. And players are also, variety of players are here, banks are there, NBFCs are there, and the new fintech, everybody is around there. So that way, that is from the supply side also, quite a lot of factors are supporting the view that the retail segment will be growing. Then on the demand side also, people definitely would want the higher standard of living to be enjoying, especially after this period of hiatus of 6 months or more. Once the normalization happens, everybody will be more enthusiastic to enjoy life rather than be more, because the risk averseness which was there during this 6-month period, that would have been corrected. So based on this, we should expect the retail credit to be really be growing that normal way. Definitely, it is not going to be dented. That is the first part of it. The second part of the question you asked, one is about retail, other is about unsecured credit.
Yeah.
Right? So unsecured credit. Unsecured credit, if you have in terms of, again, on the retail segment, I'm not talking about the business and unsecured credit. That's a different argument. In terms of customer credit, unsecured, that is primarily in the form of credit card loans. That's a major one, and and e-commerce related loans. These two are mostly unsecured. Here, credit card outstanding, which was growing until March of until last fiscal. During this 6 months period, actually it had come down. Normally, I had kind of expected in the beginning of the COVID period that the credit card outstanding will be growing up. It had not happened. That is something was a surprise to me. I'm unable to really understand, because when the people were in trouble, when their cash flows are affected, the natural ready tendency, when the money is readily available in the form of credit card, they did not use it. Whether it was because of the high penal type of interest that restrained them, that we need to see the study more. But the fact is that during this period, the outstanding has actually come down. Even though it was growing in a robust way in the last 2-3 years, every year the credit card outstanding was growing up to 20%, 25%, even more. That has, I would think that going forward, it will pick up again. Because that means that people are ready to use credit card outstanding as a source of funding when they are sure of, when they are not risk averse. So that will be the period when the economy has turned better. That would mean that they'll be able to take that risk. Yes, I have the confidence to pay off the whatever outstanding through my credit card, through my normal earnings. That confidence will return. That would mean that the credit card outstanding will go up. That is one. And the second segment of the unsecured credit in terms of retail is through the e-commerce. Because on the e-commerce, when you buy something, it is typically based on assessment of your model assessment on your credit standing, rather than be seeking a kind of security or pledge or whatever. It is not. So that is another. That is definitely is increasing. E-commerce is increasing. And the easiness with which the pre-approved loan, pre-approved limits, that's a current trend across the system. So that may kind of lead to excess borrowing or not, that we have to see. That's where all these people who are building this model, they say they certify that our models are robust. We will not allow a party to be overextending themselves, because the underlying factors which we study and analyze is much more robust than the earlier days of simple kind of impressionistic way of giving the loan. So that to that extent, we should feel confident that e-commerce loan, even though it is unsecured, it will be in a sound manner. That's a thing. So on both accounts, I would expect unsecured credit in the retail segment should be increasing. But unsecured credit in the business segment, that banks have burned their fingers in the period. The corporate loan, that's a concept which was being extended by the banks as unsecured, or the loans to the holding companies, instead of doing directly to the projects and specific to the operating entities. That these two have definitely resulted in big stress for the banks. I won't expect the banks to entry into those segments. So that unsecured loan is unlikely to grow.
Right. Thank you. Another question that we've got is that we've seen a lot of banks raise equity over the past 6 to 9 months. So is it possible that we might see some stress come over the next 6 to 9 months, because that is what the banks expected when they raised equity? So are there any surprises still left over the next 6 to 9 months?
Yeah, during this period, banks went in to raise more money for two reasons. One is that in the initial period, everybody was as all of us are discussing, that they expected the stress to be very, very large in the year to come. So that's why they thought that it is better to take shore up their capital well in advance. That was one reason. And Reserve Bank was also nudging all the banks both private and public also, that you should be shoring up your capital capacity to bear large losses you should have. So now the situation is kind of positive for you to raise additional funds. Why don't you go and raise additional funds? So Reserve Bank was also putting pressure, and the banks themselves also thought that when the money is available, then let us take it. So that's the way during this period the large and the market was also ready to fund them. So both from the demand side and supply side, it worked well, and banks could raise sufficiently large capital to shore up their capital ratios. Whether is it for possible stress down the line to cap? Obviously, capital is meant for that only. That's why they have taken. But today we are discussing whether it is going to happen or not. The stress is likely to be more or not. Our conclusion, as I in the beginning, as I mentioned, that it is not going to be. So it is going to be surplus capital for them. That would mean that it will be able to. They will be able to support the further credit supply based on this additional capital. They will have enough elbow room for expanding their credit growth. So that's the way I see it.
Got it. An additional follow-up question to this might be that banks have parked about 6 to 7 lakh crores of liquidity with the RBI. Now, given that they'll be coming out of moratorium, the economy has also opened up. Can we expect credit growth to also come back because banks have enough liquidity now, which they'll start lending to the borrowers?
Yeah, I have a view that credit is not going to grow so robustly in terms of absolute amount. Because I see what we are, if large credit growth can happen only when the corporate credit, project credit, and the infrastructure related credit happens, because that gives the size. However much banks will be able to increase in terms of their retail loan book or housing, vehicles and all, that won't add up in terms of absolute amount. It will add up in terms of number of loans sanctioned, number of people borrowing. That will happen, but that won't really be clocking up a high absolute amount. That way, credit in terms of amount to be such a, out of these 6 lakh crores of surplus which the banks are parking, how much in the rest of this year it is going to be turned into credit, I won't be able to say that the entire 6 lakh is going to be there. Because in the last, as you look back in the last fiscal, last 10 years, the average credit growth in terms of actual credit growth, that has been in the region of 6 lakh crores to 8 lakh crores only. So that is one whole year. That one whole year of normal year's credit growth, can it happen in a half year now? It is unlikely.
So Mr. Gandhi, just joining the dots with this answer that you just gave, Tej, with the preceding point that we've got a whole bunch of banks, they've raised extra tier 1. You've got several private sector banks now, and some large NBFCs as well, with capital adequacy ratios in the 20% mark. And we're faced with a climate where credit growth might not be, that exciting. Right? It might be, perhaps low double digits, maybe at most 12, 13%. So if you combine these two things, you've got a bunch of large private sector lenders with strong capital adequacy ratio and a low credit growth outlook. What does that amount to? Does that amount to us seeing consolidation, or is there some other outcome that we could see?
That's a different question. You are looking at a sub-segment of the banking.
Right, sir.
My first answer was about the banking as a whole, or right, finance as a whole.
Yes, sir.
Right. Within the segment, there will be variation, obviously. The people who are well ahead of others in terms of capital adequacy and their books being very good, so they will definitely able to go robustly at 20% plus. Okay. Because of their strength, which they have shown all these years, and because of their capacity and expertise in terms of underwriting, new underwriting, they will be able to certainly clock much better growth than the other banks or other financial institutions. Right. That difference will be there.
So you're saying system level growth might be weak, But for select institutions who have a pedigree of growing at 20-25%, there is no reason to believe
for them to continue that.
Right, and they have added excess capital now. So just on the narrow aspect of that excess capital, as you said, one possibility is the excess capital gets used by the banks or the NBFCs to pursue rapid growth. Is there any other scenario, given that we believe that, given that you highlighted that stress over the next 6-12 months might be lower than hitherto expected? If stress is lower over the next 6-12 months, will this expectation of consolidation in the sector fructify, or do you not see any radical reason for consolidation where the better capitalized lenders acquire the lesser capitalized lenders?
Consolidation, that is not going to be the norm.
Right.
Okay, there will be some odd cases here and there, because there are some banks who are readily looking around for getting sold.
Yes.
Banks are so that way. There are some entities who want capital infusion.
Yes.
So to that, so they are on the definitely they themselves are also searching for some suitors, and others are also ready to pick up. So that way, some consolidation would take place. That is by exception rather than as a norm.
I see, sir.
It won't be a trend if you ask that way.
Right. I see your point. Tej, back to you.
Yeah. One of the questions is that the capacity to repay for a lot of borrowers has been supported by the government and the government initiatives, whether it be the ECLGS scheme or whether it be by way of various other stimulus is given by the government. So is this a temporary phase where borrowers are being able to repay because of the excess liquidity, or are we going to see this as a continuing phenomenon?
Okay, that's definitely a more question that yes, today the support or the sizable part of the disbursements today have happened because of these external props that has been offered. Whether with this prop, these supported businesses will be able, and on the assumption that the economy is growing well, and they will be able to come back to their normal growth rate, which will lead to no longer requiring that prop. That is one stream of thought we can have, in the sense that now that a timely assistance from the government in the form of guarantee had given them enough time period for and along with the growth in the economy, they will be able to come back to their normal cycle of business operation. That is, if we assume that way, then it is not going to be these accounts are unlikely to become bad or anything. They will be back to normal. That's what we expect there, because that is what is the very purpose or objective behind such a support. Now, your question really is that whether these businesses will really be able to come out of the stress with this kind of support for a temporary, not temporary, short period support, and they will be able to back to normal business. That's the assumption we are making. That is my, at least that is my proposition, that the economy is definitely doing well. That the segments which are, again I am emphasizing the segment which are doing well. Okay, if the businesses who have got this kind of props belong to that segment, then we need not worry at all about their future prospect. That will be going on. But the other segments, because a part of these businesses who got such support, they belong to this hospitality sector, the services which have been affected, that kind of group. Whether there are good prospects down the line because they have been given breathing space by this kind of support. Whether that is sufficient, that is definitely, I am not able to come to that conclusion so quickly that yes, they will be able to come out of the situation so soon. That is where we need to really be looking forward. I would expect the government to really come out with some kind of support for this. There is one element, one segment, or one pending action by the government is still there, that to what extent they can extend support to the affected sectors beyond these credit limits which have been given to them. Credit guarantee which have been given to them. But that is from the demand side is not at from where they are going to get the demand. That is not yet clear. Because the normalcy in terms of people movement have not yet happened, have not yet been approved. So the entertainment and hotels, restaurants, travel, that is not yet, there are no clear symptoms that they will be able to get back to normalcy within this year itself.
So there's a specific facet of this question. But by the way, before I go into specific facet, maybe that's one reason, right? Your shopping malls, your restaurants, your hotels, your travel hasn't yet taken up. Maybe that's why the credit card piece hasn't picked up. Right? Even if you wanted to spend money, there's nowhere to go, so to speak. But a specific facet of this question of distress, in this whole Kamath Committee restructuring guidelines, we are getting two polar views. One view, which is sort of trotted out in the newspapers almost every day, is some new type of moral hazard will be created. It will be fashionable to take restructuring up. There will be no stigma associated. Your CIBIL score will not be affected. And therefore, one expectation is on the back of this new restructuring wave, lots of corporates, moving from retail to corporate, lots of corporates will now avail of restructuring. And we will now be faced with a credit quality issue as we get this restructuring wave coming through over the next 6-12 months. That's one view. The other view we are hearing is, well, no, hang on. The Kamath Committee guidelines are so narrow, so precise. Not too many corporates will be able to avail of the restructuring window as per this Kamath Committee thing, and hence there's no great risk of a credit quality blow up on the back of this. Which school of thoughts do you belong to on this?
I support the second view, because the parameters which have been suggested by the Kamath Committee, it is not giving that kind of free play for any corporate to simply become eligible for restructuring under that arrangement. It is not by automatic. Many people think that it is going to automatically, I am an affected segment, so I am going to get it. No, it is not. So it is going to be a real test for them to prove that they are eligible for restructuring under the Kamath Committee recommendation. It doesn't mean that they cannot be restructured at all. In that case, they have to be restructuring under the old 2019 guidelines.
Right.
Standard guideline. In that case, the banks will have to consider it as a NPA and the kind of thing. All those things will, they won't get the benefit of non-reclassifying.
And so if they get reclassified under the old guidelines and banks classified as NPA, then the whole NCLT system is still in play for them, right? That you get it from so many days before you go into the NCLT.
That's right.
Okay. So your view is that Kamath Committee is not some new creation of some new restructuring hell that will begin a new. Okay. That's interesting. Tej, back to you.
So there are a lot of questions around how do we reconcile this data on the increasing repayment capabilities of the borrowers with the GDP data that we are seeing, the negative growth in GDP for the financial year for the first quarter. How do we reconcile that with the lower stress than expected that we are seeing on the bank's balance sheets and NBFC's balance sheets?
Yeah, that was my argument, right? That GDP negative figure, what we are seeing, that is such a large 23 or 24%, that was in relation to Q1. Right? Q2 figure, I am expecting will be a pleasant surprise, or it will be. Because the economy, as I said, these assumptions, if whatever assumptions which I have made, if that is true, then we should be expecting a very pleasant surprise in Q2 onwards. If one part of the economy, sizable part of the economy has really been growing well, as I claim, in that case, the GDP figures should be giving us a very reaffirmation of that. That is going to be a surprise for us. That would automatically mean that the Q3, Q4, we have to reassess the number. Automatically it will come. Once the Q2 figures come, the projections about 3 and 4 also will be able to revisit. So that's why the fact that the actual credit has come down during this period consistently. That means people have paid only, no? It is all accounted figure. It is not based on any model assumption projection. It is actual. Credit outstanding has come down, deposits have grown. both are clearly true. That is where how people are able to have that much surplus. Somebody has to answer that, right? If you are keeping it as deposit, that means that you have got it as a surplus more than what you require. That is where that's why we should not be guided by the Q1 high negative GDP growth and look at the we look at the behavior. People have paid off. Banks are reporting higher collections. These are all true figures only, right? So that's where we need to wait for Q2 figures to come and then we look at it.
So just to sort of try to articulate in sort of layman's language and in a way my language what Mr. Gandhi is trying to tell us. He's saying that, look, there are two clear signs that the amount of money in the system has increased. One is if currency in circulation, if bank credit outstanding has decreased, in a way people have deborrowed, deborrowed, right? So that money, that where did they get that money from? Where did that flow of funds come from? Secondly, if you look at RBI's FX reserves, they have swelled by 80 odd billion. By definition, the RBI's FX reserves is foreign money coming into India, whether it is ECB, whether it is FPI, FDI, right? So there are two sources of funds, so to speak. One is the paying off of pending bank loans over the last 6 months. The second is foreign money coming to India. You add the two up, roughly you're ending up with a figure around 150, 170 billion dollars, right? So we know that money has come in, foreigners and local paying off. Then all you're left trying to figure out is, well, how is this money even spent? By looking at the government spending programs, you sort of account for roughly 4-5% of GDP as government spending programs. You're still left looking for 3-4 more percent of GDP to get to the 150, 160, 170 billion dollar number. But that this is an identity. If the money has come in, foreigner money and the local unsaving, if that money is there, then it has to have been spent. It can't have gone into the ether. How has it been spent? The government one is easy. We can see that. There is something else that it's been spent on that all of us are a little scratching our heads. Hopefully the GDP stats, if our CSO stats are good enough, we'll get some inkling of that. But what Mr. Gandhi is referring to is a monetary identity. He's saying the money couldn't have gone into the ether. It's up to us to figure out before the GDP stats come out where the money has gone. The government data is easy. The government spending surge is easy to explain. But the rest of it we'll wait for the GDP data, which is why I guess he's so confident that the GDP data is a relatively positive surprise for the second quarter of the year.
Another set of data that you look at the payment figures published by Reserve Bank, that also you look at various types of payment. RTGS, I look at clearly at RTGS, check payments, because these are all typically relating to businesses. The large value payment, ordinary people do not make.
Right, and what's that data telling you, sir?
Yeah, that's what I'm saying. See, by March figure, RTGS was 103 crores, 103 lakh crores. March. April onwards, it was 56, they went to 62, 76, 83, right? It is consistently increasing, but the August figure was, there is a dip, 63. So from 56, it has gone to 83.
Right.
And paper, that's a check clearing system. Because check is today, individuals do not use checks at all, typically. It is basically businesses. So there you see the pre-COVID, that's a March figure, was 5.65 lakh crores. March figure. In April, it came down to 1.63, then went up to 260, 4 lakh crores, 4.33 lakh crores, 4.25 lakh crores. So slowly the economic activity is because a check if is issued means that it is against some kind of business activity.
Yeah.
So that way also these two are clearly business related and the people related. If you look at the credit transfers, and the debit transfers, card and other payments, they're also month after month it is increasing only. So we have, for example, credit transfer, we have almost reached March figure. March figure was 28 lakh crores. In April, it was 16 or 17 lakh crores. Then it went to 20, 24, 25. Now it is 26 in August. So that way, activity have been increasing. It is all reaching pre-COVID level. That can happen only if they are really, again, on the assumption that if we grant that one group is not functioning, other group has been extra functioning.
Mr. Gandhi, one explanation could be that it's simply pent-up demand. That last 2-3 months has been pent-up demand, and once the pent-up demand fizzles out, we will revert to some sort of new normal, which is significantly lower than the old normal.
That is one. One group argues like that. But to counter that, it is now it is a festive season where people typically we have seen for year after year the October, November, December have always been higher economic activity in terms and higher consumption activity. And to support that consumption activity, you have various factors which is supporting. Agriculture, rural sector have definitely been thriving very well. That everyone grants that, and this kind of surplus people have. So that is why it is not just a pent-up demand alone, which is meeting that. In addition, the normal higher economic activity period has also reached.
Very interesting. Tej, more questions, Tej?
Yeah. One of the questions that we've got is, this is sort of a question that we get during a crisis, during every crisis. How do we see the stress on the balance sheets of NBFCs? And will the path of recovery for NBFCs be different from banks? Will there be room for NBFCs to thrive in the post-COVID world?
So NBFC sector, if you look at last 15 years or so, or even 20 years, 20 years, if you see, they have their own cycle of activity. 2 years they will grow, 1 year they will dip. Again, 2 years they will grow, and another year they will have a problem. That has been happening right from mid 2000s onwards. That way, if you see the data, you can clearly see that. That is a standard arrangement. Then when they are dipping, if it happens to be siding with economic activities also sliding, then the impact on them was quite large. That is because their cycle is a little, as I said, within 3 years, they have their business cycle kind of thing is happening in kind of 3 years, whereas economic activity cycle is a little longer period. That's okay. So that is one reason that periodically NBFC sector has been having some kind of stress. But how exactly happened, I don't know. At least the trend we can see that a very short period, they have been having problems. But over this period, their approach has also been, their business models have also been changing. Their focus also have now turned more towards retail segment, many of them, and by traditional segment. In between, they had also kind of tried to imitate banks and corporate lending and project and infrastructure lending. They went in a big way during a short period. Again, they have come out of that. Now their concentration is mostly in SME lending and retail book. So here they're all now depending upon more on proper modeling, alternate cash flow based, information based cash flow analysis, not just the security based lending. So their business models have also changed. That is for the better. That is the one segment continued to have, among the NBFC sector, one is going to have problem or continue to have problem is the real estate. Which are NBFCs who had a sizable book relating to this segment, they have been a problem. That continues to be. That group will, I don't see any good prospect for them to come out of that stress so quickly. But whoever is having good portion of their book relating to SME lending and retail book, or normal personal housing related, they will all be doing good.
Okay. There are a few questions around urban lending versus rural lending. We've seen that the rural economy over the past 6-9 months, even during COVID, has been faring better than the urban economy. So should we expect credit to flow more towards rural India than it was flowing to rural parts of India before COVID? And will banks and NBFCs start setting up more and more branches, increase exposure towards rural India over the coming 3 to 5 years?
Yes, rural background is a very good hinterland. Demand is going to be there, but it is a question of supply. That is the players, the banks and by NBFCs, whether they want to be operating there directly. To what extent they have the capacity to go there. Earlier, the physical presence was needed. Rural means that you have to have a branch there, kind of. And that's the reason there was always a limitation for the rural demand to be tapped by the mainstream financing institution like a bank or an NBFC. So even today, that challenge still continues. That is where technology could bring in or has been bringing changes. To that extent, the rural credit growth by the banks and NBFCs have good prospects. But to what extent they are ready, they want to do it, that is still a question. Because as I said, that personal touch in terms of onboarding the customers and later on continuous monitoring. So that is where the banks and the NBFCs may have a hesitation still, as despite the technology being available to do a credit assessment. That is onboarding only. But continuous monitoring, and I think technology is not yet fully, technological solution is not yet available. That is where the hesitation will continue on the part of the banks and NBFCs go in a big way. And for that reason, will they go ahead in terms of branch expansion? That is the second part of your question. That also banks either, because now that the banks have the freedom to determine what a kind of branch presence they should have, that is full-fledged branch expansion in rural areas is not going to be there. Rather, banks will be choosing to operate through banking correspondents and fintech and MFIs. So it will be an indirect lending that will be the choice by the banks rather than through their own physical presence.
Right. There are quite a few questions around what will happen to the PSU banks over the next 3 to 5 years. Do we expect to see what we've seen over the past 5-10 years? Do we expect to see private lenders gain market share? And what will the government look at doing in terms of, say, recapitalization or mergers or privatization for these banks?
Okay. Privatization of public sector bank is not going to be in the cards in the short-term period. In 2 to 3 years, I don't think that will happen. Because that requires a very large political consensus or political will. Either consensus have to be built or the will has to be real strong to go for that. That I don't see coming so soon. Even in the current dispensation, which is more otherwise for privatization of public enterprises, about the banks, they won't go whole hog for the reason they also now understood the importance of banking for government policy pursuits. So rather earlier the expectation was that it is a public sector banks which should be supporting public policy, whereas the current dispensation we expect even the private sector banks also to be part of that kind of exercise. So that's why I'm not very sure that privatization is going to happen so soon. That requires, as I said, that some 2-3 years later only that question can be revisited and rethinking would be there. What happens to the public sector banks as they are? Further consolidation, that could be possible because there are some public sector banks who are still some kind of solution need to be found for Bank of Maharashtra, IOB, and who else is left out? UCO Bank, no, not UCO Bank. Whatever, those the 3-4 banks, they are the PCA banks. So that some kind of consolidation we should expect. That's one. The second, for capital for these public sector banks, government will certainly be putting in forth, year after year also they will be coming, but their expectation will be more for these banks also to go to the market and raise funds. Without bringing down, there's a 51% will remain with the government. So to that extent, there is headroom for the governments to dilute the holding. That will happen. That will happen. But it is not privatization as such. Strategic investment. That's another. That's even in the public sector bank, whether a very large investor can be allowed to come in. That's another question which is being debated, because as of now, the requirement is that 20% up to 20% only when somebody can be there, but that also widely held rather than by a single party. That can change. Possibly, government may agree to let a single party or a single group to have a larger stake in the public sector banks, but government will still have 51+. But some strategic investor could be roped in to banks, to these banks, either to revitalize because they can bring in expertise, technology, or whatever. So that's a kind of thing that can happen. That is a possibility to happen.
So let me just quickly clarify a few points. I think Mr. Gandhi's made several interesting points. Let me quickly do a summary for our clients, and then I'll also pose a question on interest rates over the next 12 months for Mr. Gandhi. So first off, he's saying that, look, if the credit quality outlook is better than hitherto expected, and strong, well-run lenders have raised lots of capital, it is logical to expect these lenders to use this capital to grow their book at 20-25% over the next 1-2 years. Like, they have the money, credit quality outlook is not as bad as we thought, credit growth comes back, and strong, well-run lenders just do business as usual and carry on getting back to what they were doing 1, 2, 3 years back. The second point he's making is that, as is, I suppose, well known to some extent, there are 3, perhaps 4 private sector banks who are looking for suitors. At least 4 in the public domain, we seem to know they are looking for suitors. And in the NBFC world, the real estate focused NBFCs will also be going through their stress. And therefore, these private sector banks are looking for suitors, and the more stricken NBFCs are natural candidates for whatever consolidation we might see over the next 1 to 2 years. Mr. Gandhi is saying consolidation won't be the norm. I agree with him, it won't be the norm. But there seems to be enough opportunities for those lenders who have excess capital to go forth and use that to perhaps consolidate those banks who need a suitor, or those NBFCs who need a suitor. The third element is the whole PSU point. Mr. Gandhi is ruling out the government privatizing full scale. Even though the government has said that they might try to IDBI Bank, they might try to expedite that, but that's not really a full-fledged PSU bank, I guess, right? And we've been hearing for a long time that IDBI is imminently going to be privatized. So if you rule out privatization of PSU banks, then the only source of capital for PSU banks really is the stock market. Now, with several of the PSU banks, the government holding is already around the 51% mark. So the headroom that the sovereign has to raise equity capital for the PSU banks might not be that much, which is why I suppose Uday Kotak said, I think last week, Uday Kotak said that over the next decade or so, the PSU banks' share could go down from 65% of loan assets to around 50-odd%. So the PSU bank shed some share because the government is going to encourage them to raise money from the stock market, subject to the government's holding not going below 51, and that doesn't leave that much headroom. So potentially that PSU bank share of around 15-odd% migrates to the private sector lenders who have the excess balance sheet, and that's really this construct of incremental consolidation in terms of weaker private sector banks falling into the arms of the stronger private sector banks, real estate focused NBFCs getting consolidated either by private equity or by banks. consolidation of PSU bank market share going to private sector banks, and leaving aside all of this consolidation activity, business as usual, where strong, well-run lenders continue growing their businesses at 25%. I think that combination is really as good as it gets in this current economic climate, where, to be honest, nobody on this call, I think there are 323 people left. Mr. Gandhi, Tej, I don't think any of us is expecting a roaring credit recovery here. In the absence of a roaring credit recovery, this sort of outlook is pretty good. It's as good as it can get in the current economic circumstances. So coming to the question on interest rates, clearly over the last 6-7 months, because of exceptional circumstances, the cost of funding has gone down by 2, perhaps even 2.5% for the better run lenders, whether it be public or private sector banks. RBI window, interest rate cuts, whichever one looks at it, cost of lending has gone down by 2.5%. The stronger NBFCs like say an HDFC or a Bajaj Finance are borrowing at 4.5%, and the stronger banks in the RBI repo window are also getting credit at around 4.5%. Now, if we are taking the view on this call that the credit outlook isn't as bad as was feared 3 or even 6 months ago, if the credit outlook isn't as bad, should we expect the cost of funding to inch up by say a percentage odd over the next 12 months?
Cost of funding is unlikely to increase because the Reserve Bank and the MPC has clearly mentioned that the accommodative stance is going to continue for a longer period, at least definitely during this fiscal, and if not for the next fiscal. That is one. Number two, Reserve Bank had its LTRO window. It is for 3 years. 3 years funds. So the banks who have found an opportunity, if they are looking forward and by credit is going to pick up, then they can lock in that kind of large funding at low cost now itself. So correspondingly, they can offer very competitive or lesser interest to the low interest to the borrowers. So that's why I won't expect the interest rate situation to go up in this fiscal. Definitely, it is not going to happen. The only caveat will be how inflation behaves. Because if inflation behaves a little drowned and suddenly if something happens and MPC needs to revise their policy rate upwards, that will be a little different one. But as of now, it is at least the projections on inflation is that by next this quarter and next quarter, it is going to come down and it will be well within the policy objective. So that is why it is. I would say that cost of funds will not be growing or will not be increasing in this current fiscal. There is no chance.
So before I hand over to Tej, I think this is the point Mr. Gandhi has made, I think has incredible salience for everybody who's listening. Even if you assume inflation comes down to 4-5%, your real interest rates as a depositor, the real interest rate that you're getting as a depositor is close to zero. Right? And it's unlikely that you will be getting a positive real interest rate as a depositor in the foreseeable future. Right? So everybody's on this call, all of us, it's unlikely any of us will be getting a positive real interest rate as a depositor. My reckoning is what that does is it will force people towards risk asset classes. Now, whether you go and buy gold or whether you buy Indian stocks or foreign stocks, that's your prerogative. But this sort of environment is classical push by the central bank, pushing savers, people like you and me. They're pushing us away from deposits by giving us a negative interest rate on deposit. They're pushing us into risk asset classes such as gold and the stock market. And I think flows therefore into the stock market or mutual funds or gold.
One caveat there. It is natural to expect that the growth path for the ordinary, say, risk-averse investors to go into gold or stock, right? So that is the expectation. But there is one more intermediate step. That is what is going to happen. Debt funds. Debt mutual funds is going to be the biggest attraction for the people who will be shifting away from bank deposits. That will be their first stop. So if a good offering and marketing and distribution chain, depending upon that, there will be a very good offtake of debt mutual funds.
Very interesting. Tej, one last question before we thank Mr. Gandhi for his sterling contribution this evening.
Yeah, sure. So one common question that we've again got is, if we combine the data on collections and on increasing deposits for the banks, does it mean that consumer demand is coming off as savings are increasing? And secondly, does that mean that over the next 2 to 3 years, we'll see that savings will go up, but demand in the economy, consumption will all taper off?
I don't think people are saving by reducing consumption. That's an assumption they are making. Going forward, the economy will shrink in terms of consuming and will be saving more and more. No, that will not happen. That can happen only if depression kind of economic situation comes. That is where the consumption will go down and people will sit on more and more of safety in terms of saving. So that's we are projecting the economy will grow. When economy grows, that automatically means that consumption will also be increasing only. Savings may also be increasing because of increased cake. That's a different. So that's what we should be expecting. Saving will also be increasing, and consumption will also be. Consumption is definitely not going to shrink.
Okay, great.
Thank you, Mr. Gandhi. This was incredibly valuable. I think I have to confess, I've never seen monetary statistics being used in the way you did it. It was breathtaking. There was so much to learn in those 20-25 minutes where you told people like us that don't just look at GST collections and ask yourself where's the money coming from. Go to the RBI website, see the RBI data on credit outstanding, on deposits, on currency in circulation, on RBI FX reserves. And I think you've given us a master class in using RBI aggregates in a constructive way to further our profession. For everybody who was listening, I am the first Kings of Capital investor. 12th July, Tej allowed me to invest in the Kings of Capital. I think in the last 2.5 months, Tej has delivered 4.5% for me, which is a par for the course. We are compounding at 20-25% in investing in market leading banks and life insurers and general insurers. And my expectation is over the next 1, 2, 3 years, given what Mr. Gandhi shared with us, returns in the vicinity of 20-25% from Kings of Capital should be what we should expect. I think to expect more than that is unrealistic, and to expect less than that is fatalistic. In India, if you're unrealistic or fatalistic, life gets very difficult. So hopefully we'll continue serving you, and hopefully you'll continue reposing your faith in us. Thank you very much to everybody for their time, and thank you especially to Mr. Gandhi. Thank you, sir.
Thank you very much. I enjoyed. Thank you very much.
Take care, sir. Thank you.
Good.
Bye.
Good evening to all of you.